Good morning, beautiful people of the internet, and welcome once more to the Sunday special. Joined by myself, as always, with Helen Chorley, Piotr Rusinek, and not by any means least, Mr. Adam Lawrence. And we are here to guide you through the tumultuous waves that we're seeing in the market today. This is property, finance, economy, random banter, and a bit of fun. So we normally let Adam kick off because his Sunday supplement is gaining more traction than The Economist. So we're going to get the cliff notes. We're going to try and say some positive things and some, well, probably instead of positivity, some practicality is probably what the world needs a little bit more of. So Adam, take it away.
Well, that's a really good intro, Jay, because that was a real driver this week for me, because I've been getting a lot of correspondence and I've been seeing a lot of stuff, and face to face with people. I'm reading a bit of fear into some people's eyes, and I like to try and do my little bit for calming the waters and being realistic in these situations. Yeah. And so I did have to summarize the utter bloodbath that was the early part of the week from a political and from bond market and interest rate perspective. We've probably said enough. I'm keen on trying to avoid ad hominem attacks generally, so I find myself deleting lots of things I'm writing about Liz Truss at the moment. But in reality, it's quite obvious that what was evident in the campaign, that she probably didn't know what she was doing from an economic perspective, has been proven in the last 7 days. There's a few ways out of this from here, some of which are relatively soft. Postpone the tax cuts, publish the OBR's figures, stop thinking that you're Donald Trump and that we're the USA. That's all possible. Of course, she might double down. If she does, maybe we'll see another change of administration, but we'd have to see that with an election, of course, this time around, because they just can't do another leadership contest. And it just makes you think, the country and the MPs, the Tory MPs, would have voted for Rishi, and they're all turning around at the moment saying, I told you so, basically. But that's the bits and the inner workings of the derivatives and what was happening in the pensions time bombs. That's all covered in there if you want to read about that stuff. It's then really on to what are we going to do about it. And there's ultimately, obviously, as always, it depends on your position and your situation. I don't think it's the time to be holding any floating rate debt, if at all possible. I've been banging on about fixing for a long, long time now, so I won't do that one more time. Although I did do it one more time this week. And my little strapline was fix at 6, because if you can still make stuff work at 6, I'm not saying that's going to be the optimal play for the next 5 years. But if you're of a remotely nervous disposition, and you don't want to take that upside risk and it still works, you know what? You've got to asset manage quite hard. Rents are still going up and they're forecast to be going up quite a lot. If it still works at 6, then great. If it doesn't, well, maybe repurpose so you are getting 6. Maybe sell, maybe take lower LTV, pay down some debt. If you're paying down, instead of borrowing at 6, you're getting a 6% return on your money, and you're in full control of it. So that's not so bad. Yes, inflation is 10, but one way or another, it's coming down, and it's going to be a bloody mess by the time it does come down. And of course, it has been capped by the energy price cap, which is the one thing you can support that's been done so far. And of course, that's the thing that has probably spent about 75% of the theoretical money spent so far. It was amusing in a way to note. I noted it this week. My favourite bit of irony, true British humour. We pursued austerity when we should have been pursuing growth last decade, and now we're pursuing growth when arguably we should be pursuing a bit of austerity. And the problem is, England/the UK has gone into having the more ideological of all of the leaders, even though Sturgeon has made some poor ideological decisions, and Drakeford has copied what Sturgeon has said, and no one turns up in Northern Ireland. But that's not an ideal place to be. And I was sad, but I think accurate in making the comparison during the week that Truss is a bit like the equivalent of Corbyn, just painted in a completely different colour, in that ideology makes decisions ahead of fact. and I'm not a big fan of all of that. And also, Jay, this week Jordan Peterson was interviewed by Piers Morgan, so maybe we can talk about that in a bit as well. I don't know if you've seen that yet, but that was interesting.
I saw Jordan Peterson was interviewed recently by Russell Howard, the comedian.
I haven't watched that yet, but I did see it pop up on a thumbnail. Yeah.
It looks really good because he asks pretty smart questions. Russell, normally he's like asking children like really random questions, and it's funny outcomes. It was a TV show that Michael Barrymore used to do, where he'd like have the 3 or 4 kids on the stage, and they randomly come out and say,
"Are you smarter than a 10-year-old or whatever?"
Yes.
Yeah, something like that.
Look, pull that out,
where the kids would come out and say, "Oh, my mummy likes to sit on all 4s" or something like that, and like really random stuff on national TV. But it was a good art. It was a good.
May have to go on mute for a moment, folks. Just oh dear.
I'm quite proud of myself. I think I've gone maybe 2-3 supplements without spending most of the time swearing.
Yeah, well, absolutely. A man with your loquacious talents should never need to curse, my friend. Come on.
No, that's a fair point. But sometimes it's really good punctuation, profanity.
You do it with class, so we let you off. That's the thing. That's the thing.
Interesting, your the supplement, and I think there's a part in it that's going to be useful for a lot of people. Is actually telling them what rental stress tests are like from the underwriter's point of view, and how and I obviously in the last 24 months at the very least, during the COVID lockdowns and all that kind of stuff, property prices didn't abate in any way, shape, or form. In fact, it was probably driven by a lack of supply and increased demand, right? People, debt was very easy to come by, as it has been for the last 15 odd years, and all the other bits that you kind of mentioned. But I think that bit's really very important for people to understand, because there is a lot of upside risk in that, in holding, working the asset, maintaining it. That's your risk. On the upside is that you keep the asset, you can furnish the debt essentially, but not a great deal more than that. And I think we're gonna see a lot of people who were, I'm into real estate because someone like you, Adam, I'm looking to build a portfolio, I'm looking to house people in good quality housing, all the lovely blah blah blahs, and then just those people who are, I want a £10 million property portfolio with £100,000 income because I want to go live on a beach in the Bahamas, right? There's the difference of properties that get rich quick.
Yeah, Malta.
Yeah. But you know what I mean? Like it's the next couple of years are really going to sort the chaff out, and I think that's going to be an evolving part of the process, because and it's going to be interesting to see the rise in numbers from landlords exiting the market, because that's been a steady increase over the last since section 24 at least, right?
I think there's a really, really good point you've raised there, Jay, because I've called them the zombies for years. These people who are on base plus a little bit, who section 24, all the rest of it, they've just sat on it and spent the money. And since 2009, and when base is 6 and they're on 1.7% above base, most can't service 7.7. When you consider section 24 adds an artificial probably 25% onto that rate. So they're doing about 10 realistically. And most stuff doesn't stress test at 10. We stress test at 11, right? But that's no money being made. And if the danger has always been, if you're at 11, prices are going down because credits effectively evaporate. So it's all very well stress testing at 11, but if I stress test at 11, I'm starting to get worried at 8.5,
Exactly.
That's the thing. Like, if people want to sell, they need to choose the right time to sell. You can't sell what everyone needs to sell or wants to sell, and there's no one else to buy.
This is
or
the
people
lesson
can't
of
get credit.
2008, isn't it? This is exactly it's not just us wanting to sell at this time. It's everybody in the market wanting to sell.
Yeah.
Well, I mean, it's a kind of although you've said it before, you didn't say it in today's supplement, but it's kind of you. And a lot of people say this, and we do as well. You make your money on the entry point, at the point of purchase. either you're buying well and you can, you know, add the value or have it let and do all these other things, or you don't buy well and then you're in a struggle and you're unlikely to.
Got an assistant, young assistant.
Yes, indeed.
Apprentice.
She doesn't miss a second about the macroeconomy. This one, she suggests that. Yeah, that's it, Jade. Sharpening the axe a little bit is, you know, price is a blunt tool. I've said it many times before, but it's also your protection in these circumstances. And the dangers in being a motivated buyer are always there. But at the moment, goodness me, you know, if you, you know, if Rod's perspective is you don't buy for income, you buy for capital growth. You know, we have a reasonable difference in philosophy on that side of things. But ultimately, if you can't buy for cash flow and then you don't think there is short-term capital growth, yes, we always say time in the market, not timing the market. But there's a big difference between holding what you've got, sweating it, active asset management, and expanding. And ultimately, if you can't expand, or, you know, build to rent isn't, you know, build to rent's built around 3.5–4% returns. Yeah. If that's the 50-year gilt return, which it was this week, higher than who builds to rent, for example. You know, they're just, if you look at what gets funds involved in a specific area, like Birmingham, I can talk with some experience about. They have a 5 or a 10-year view on the Birmingham capital growth because they very much agree with Rod's perspective in that the money's in the long-term cap growth, right? But it's going to have to be a margin on top of that gilt yield in order to get involved. It's as simple as that. So, you know, we need this to. And I was looking at historic, because I'm so rock and roll with all the spare time I didn't have this week. I was looking at the correlation between long gilt yields and mortgage and the base rate. And Rod's posted some really good stuff this year about it's understanding the relative difference between the 70s and today and the 80s and today and the 90s and today, because the pay will, it's like, you know, if you go in if you drive a fast car, there's two things really. There's the top speed, but there's the acceleration. And really, in my opinion, the acceleration's the fun bit, right? And you can go from 0 to 40 on a 40-mile-an-hour road and not break any laws, right? When you get to 40, it's kind of a bit of an anticlimax sort of thing, but that's where you are. So are you growing the portfolio, or are you maintaining the speed and the fuel efficiency at the moment? And if you're taken out from being able to grow it, as you were saying, the classic COVID supply-demand issues, rental supply is down 26% from pre-COVID. Rental demand is up 6%, which is much more what you might expect over that time. And that's why, you know, these supply side measures that the Chancellor mentioned are sensible. They're just not costed sensibly, and they probably won't be executed sensibly, unfortunately.
Wow.
Well, there's the other issue of loan to values, right? Since the last financial crash, you know, you had all those mortgage instruments that enabled you to borrow 100% plus cost of refurbishment and all that kind of stuff. Lending's become a lot more sensible and a lot more regulated, which is great for everybody. But actually, investor appetite to draw out funds and then on a reval 2 years later with capital growth, fingers crossed, maybe that's what they went for. They then ripped out another 20–30 grand and kept that debt level up.
Yeah.
You know, what happened in 2008 is obviously nowhere near what's happening now, and certainly wasn't anywhere near what happened in the late 90s, right? But the reality of the situation is your ownership in an asset is your equity. The rest is hand. You know, you've got the dead pledge, you've got the mortgage to somebody else who essentially owns your asset, or you're paying the piper for. So, you know, if you don't have equity, what do you have?
Yeah. What are you doing it for? And this is back to those, where did people get in trouble in 08? Well, valuation requirements and covenants, you know. If things do, I've said today, my spread is now -7 for the next 2 years, plus or minus 10%. So it's not a guaranteed loss, but I see an 85% chance of a flat or slightly falling market, right? I don't see a crash. I still don't see that happening. There's too many tools and too many levers to pull. And I made the comparison today. There was a point this week where the gilt yields in the UK were higher than Italy and higher than Greece, and that's utter hogwash. In terms of what you would have done with that, you could have shorted the Greek and the Italian and bought the UK, and you would have had a fantastic. I'm not a bond trader, and bond traders are way above my station. They're very, very smart people. But that's what I would have been getting absolutely as far as they would have let me this week, quite frankly.
And if people want an insight into that, basically that's saying the credit worthiness of Italy and Greece is better than that of the UK, which has it ever been? I'm not sure it has ever actually been, has it? Even in the darkest times.
You go and read Varoufakis or something, right? And he'll tell you what it was really like. And he'll also tell you that the problems that were at the peak in sort of early 2010s, they weren't fixed. They were just punted down the road. So that can's been kicked a little further than the UK can, but they're not as strong. They've got bigger demographic problems. They've got bigger tax collection problems. There's no. This is factual. This is not me being a proud Englisher or British or whatever.
I'm pretty sure like the credit worthiness of Italy and Greece was pretty good in ancient Rome and ancient Greece times.
If we go back far enough, yeah, I can agree with that.
That's a fair one. Economic history in deep depth, absolutely. Yeah. But I think you've got to also consider, as a real silly proxy, but the EU is Germany, and Germany aren't in great shape right now, right? The energy things hit them much harder than it's hit us.
Yeah.
And, they operate in an environment of austerity. So further austerity isn't much of an option, right? So what do they then do? And they still have this real big psychological hang-up. The reason, I didn't say this in the supplement, I was toying with putting some of it in, but it kind of goes on a bit of a tangent. But the reason why the markets are so worried, the international markets, and I've seen some awful defences of Liz Truss by people who clearly would only ever vote Tory, even if Pol Pot was in charge or whatever this week, right? But the reality is, what are they doing? The reality is, what they're worried about ultimately is that Liz Truss is a modern monetary theorist, right? The magic money tree exists, and we can just plough on, turn the handle on the printers, get on with it. And, modern monetary theory hasn't been proven to be incorrect yet, but that's not a great idea. That's like saying it hasn't been proven yet that if I step over the edge of that building, that I will fall, that gravity will actually work. Because perhaps I can fly, or perhaps I can, walk on water or whatever. Probably can't, can I? Probably everything we know about physics, and in this case, economics, suggests that won't be the case. So I think that she needs to prove that she isn't a modern monetary theorist in order to calm the international markets down.
Right.
But that's my view, my apolitical view.
As apolitical as one can be in modern times, right?
Indeed.
Yeah,
indeed.
and I think obviously like referring again to Ray Dalio, because that's always pretty relevant. I mean, when all this economical kind of when people become poorer and like there is the difference between wealth in growing difference between wealth between like the wealthiest and the poorest people, like that's a good ground for all the populist governments and all the other things that cause even more trouble, because then if like with Liz Truss, like this was all kind of populist type policies without really putting much thought into this, and that all kind of spreads around the world as well, because if UK can do it, then other governments will follow.
Well, you think Boris had his failings, right? But one of the things he was good at is delegation, and he would get in, he delegated to Sunak and gave him quite a bit of room, really, after he got rid of Javid. And Sunak steered the ship really, really well, right? So has Truss delegated to Kwarteng, or is she controlling the narrative largely because of ideology? I would say it's the latter. And the fact that I mean, I felt the only time I wouldn't say sorry for her, but I thought was a little bit disingenuous was the chat on the radio with the chap who was telling her about the mortgages and all the rest of it. Because again, you need to go into the numbers here. 28% of homeowners, 28% of households are owned on a mortgage. Average loan to value is 40% because obviously it's taking people from they've just bought it all the way through to they're in their final year of paying off their mortgage. Then ultimately 70% of them are on a fixed rate anyway, so only 30% of them are on variable. So there's a pocket of households, and don't get me wrong, it's not insignificant, but it's 2 to 2.5% of households who are on a variable rate tracker at the moment. Then there's the second order ones, the people who live in rental where the landlord is on a floating rate, and that's also impacted. But again, it's not a high percentage, it's a low percentage. So it's nowhere near as relevant, these points around, are you having fun? There's nowhere near, it's nowhere near as relevant as it was made out to be on the radio show. So this narrative that's now clicked of, oh, well, there's no point, controlling energy prices if people just spend it on their mortgage. Now, if that situation persists for a year, 2 years, 3 years, it starts to kick in. It also starts to affect the new people onto the ladder very quickly because they're now seeing the 5.XX residential rates. But again, I'm back to my point I've been making several times over the last few months. We stress tested at 5.5, people. So until we're above 5.5, it doesn't make an awful lot of difference. Now, when we get to 6.5, 7, 7.5, it starts to unravel comparatively quickly. But it's not like we can sit there and go, oh, well, that's it. The Bank of England have gone to 6% base, prepare for the grenade, because most people, the vast, vast majority of people are insulated from that.
That's really good perspective, actually. I didn't realize those numbers, so that's really
it's what my go-to, let's put it into perspective rather than everybody jump on the bonfire of Liz Truss. No, don't get me wrong, I don't suppose she knows those numbers either, but because if she did, if I was being interviewed and ripped apart like she was, that's exactly what I would have replied and said, those people, there will be ways and means, and we'll be working with the Bank of England and the commercial and the retail banks in order to try and smooth out this process, which we need to. But instead, it's this denial / boosterism that's saying, last Friday, she gave people a lot of confidence. Kwarteng gave people a lot of confidence, took the stamp duty away. Now, that's a cynical move to try and keep the housing market going, which now doesn't look like it's enough, right? But you don't ever forget, when you're a first-time buyer, your motivation level is right up there with someone who puts a property in an auction. You're desperate to get going. And there are quite a lot of people who haven't fired their bullets over the last 2 years, not for want of trying, but they just haven't been able to get the stock. Now we're going to see a drop in transactions. We'll see thinly, in my opinion, quite thinly traded stuff. And, you tried today, Jay, Piotr, to go and talk to vendors and say, well, look, guys, the market's on the way down, blah. They're not going to listen at the moment, generally speaking. They still want the price from 3 months ago. And the reality is they've missed the top, in my view. They've missed the top.
Yeah, exactly. It's there's a lot of people who we get about 3 times the amount of inquiries as we had before. And the conversations are, this could have worked a few months ago, but right now it doesn't.
I had a conversation this week with a guy who is very set on the price that he receives for this asset that he wants to sell. And it almost to the tune where he said to me, well, if you pay that in 5 years' time, I'll still be happy, which you've got a kind of soft option on, which is interesting, obviously. And I said to him very plainly, I said, look, if we were it's such a shame we weren't having this discussion in June 2021, because I would have been able to pay your price, no problem. I'd have been very happy to do so. But unfortunately, a few things have happened. And, 30 or 40% of this portfolio is commercial, and he's not accepting the yield expansion argument. Although when he had it valued, he'd taken pretty much all the yield compression, but he doesn't want to hear the other side of it. So at the moment, there's just nothing to be done. Even with, I mentioned this very briefly when I was talking to Will on the podcast earlier, when, vendor finance is a plugger of a gap here, because the beauty is, I think I put it in the supplement today, you still can't get 3 in the bank without going somewhere a bit strange and tying it up for at least a year, right? But if you've got to borrow at 6 and you can only get 3, there's room to do business in there at 4.5, and that's what you've got to do. So you've got to do that business. So there's always a way to. I'm being patted like a dog. Thank you so much. There's always a way to do that business, and you've got to try and carve those ways forward. So I'm looking at, there are, because people are saying, well, how can you buy stuff if you can't exit, right? Well, I'm pretty willing at the moment at 50p in the pound to get a 2-year bridge, because I'm pretty confident, and so is the bridger, that we'll be able to get off that okay within 2 years. And if we can't, do you know what the other exit is? We auction it off. And if I'm right about the market softening 7% or whatever it is, well, the 50% discount I got is okay, isn't it? So
Yeah.
that's an extreme example, but you can see how you plot that course forward. The difficulty is, and COVID's done this to all of us, this is the 4th or 5th tactical shift that we'll be making as a group in the past 2 years. I used to work in an incredibly dynamic environment where the management of change is very, very important. And it was lovely for me. I hated it, I loved going to property. People would say like, oh, what did you used to do? I was like, I was a sports arbitrage trader. You could have stuff that worked really well for a week or a day or 3 months, but you'd have to reinvent the wheel at the end of that 3 months, day, week, whatever, to find the next thing. And it's very, very taxing, because you can't forecast ahead and say, oh, I'm going to earn this money over the next 5 years. No, you're not. You're as good as your last month in trading or whatever, which I'm sure, Helen, is probably a fair proxy for, trading Forex or trading anything, really.
Yeah, it's why we burn out. It's why nobody's on those trading floors for 20 years, right?
But I suppose 4 or 5 tactical shifts in 2 years is not bad in comparison to what I used to do. But you do feel that it's probably not the last tactical shift either. And this is part of why, these chats and the supplement and everything else are useful, because they're useful to me, and hopefully they're useful to everybody, because you get to think it through. And then you get people. I had a really good chat with a guy who's part of PIP, who's a derivatives trader. And look, I absolutely defer to him versus what I do, but we don't agree on a few things. Right. And we said, we've enjoyed the exchange, good conversation. And I said, well, it takes opinions to make a market. If we all think the same thing, we've got no opportunities and no market. So more power to both of us, And that's what we need to keep on doing and keep talking.
Amazing. What are your predictions for the next week's auctions? People are a little bit kind of in flux, right? And if they can't get the rates, you can't get anything, they don't know what's going to happen. It's a bit of a flux, like in before the election couple of years ago, or before or after the Brexit vote, or some. This is like very similar type of environment.
Right.
Absolutely. I'm happy to put the stake in the ground first. I think low completion percentages. I think still, like there always is, the odd lot that goes off like a rocket and everyone goes, why is that happening? And I think you'll see some stuff come back round again. And it's interesting where we are in the year, end of September, early October. This is normally reasonably good auction time. And then we sort of cool off around sort of mid-November for the rest of the year. Now, when are the lenders going to come back to the market with not rates like 8.99 and cracker stuff I've been seeing this week, which I said, this is the equivalent of the decorator coming around and saying, oh, it's $4,000 to paint the lounge, and it's like, I see, you're just really busy and you don't want to tell me no price, so you're just going to treble what you'd normally say. And it's a bit more important for the lenders because if they shut the doors, it sends a signal to their backers and the market and everything else. So they just put out the £4,000 paint the lounge rate, that no one's taking up. Will they be back next week with some competitive offers? There might be a couple, but their service levels are still suffering from everything that's still in the pipeline because they've been so slow. So if you can't see an exit and you're a bit concerned, again, your cheaper stuff or your more complex developments that are going to end up with, multiple occupancy commercial buildings or residential buildings or whatever, I think they're still viable. But I think people will be quiet because they don't, at the moment, they're not thinking, I've got to deploy this cash because of inflation. They're thinking, hang on a second, things really might go down here. And do I want to catch the falling knife? That's my view anyway, mate.
Yeah. I was just looking at SDL results from Thursday. So Thursday was quite I would say similar day to what it's going to be this upcoming week, right? And so SDL had 153 lots initially entered into the catalog. They offered 112 and they sold 73. So basically they sold about 45% of what they initially put into the catalog. And then
so you've talked before about how the online world has changed the game. It's like it's almost fixed the numbers a little bit because they know what to offer. So in many ways, there's as much in that percentage that was not offered as a metric as there is in the. So even with the best conditions they could hope for, they've fixed it and sold 70% or 65%, and as you say, 45%. And the numbers will always tell you the story. They'll always tell you the story.
Yeah, I mean, this is the lowest they sold since April this year. They sold just under 9 million, but in general, they haven't been going into single digits, like even in 2020. So it's quite a result. We'll see what's gonna happen with like Savills auction on Tuesday and other auctioneers that are offering lots, but times have changed and people are less likely to take huge risks. That's my message to people looking to sell. If they need to sell quick, it's probably still a good time. But like we're fixing, it's probably a good time to still try to sell. But things need to be positioned well and in the right auctioneers because
Piotr, do you think that I would be encouraging people to set competitive reserves because there'll still be that 30% of the room or the internet or whatever that are looking for the bargain and happy to deploy now. And if it means you're giving away a bit of your gains over the last couple of years, like you mentioned the key phrase there, if you need to sell, what I wouldn't do is show it to the auction market at too high a guide price. So you're one of the 40 lots that doesn't get offered because no one's interested. Because that's very damaging. Very damaging. Bad time to do that.
Yeah, that's for sure. Like, you need to make sure that the lot stands out in a good way, or sometimes in a bad way. That also makes it can get some people interested. But that's for sure.
You want your property to be one of the ones that fly, right? Like you say, the random ones that you just can't figure out how it happened. And there is a really interesting point when you're pricing something where you think, okay, this looks attractive, this looks ridiculous. Do we go ridiculous or do we go attractive? Because ridiculous is a double-edged sword. It's like people look at it and think, why? What's wrong with it? What are they hiding with that price? But if you understand that price, like averaging that price point out to make sure it looks good, there's a discount there that someone can go, okay, there's some motivation, it doesn't look like there's anything aggressive in the background, then that's kind of how you want to be doing it. But there's a skill to that. So just be careful.
Beautifully articulated. Totally agree.
Nice.
So just to touch on something that I've been thinking about a little bit. I've been thinking about the state of the European economy and its member states, and something really we mentioned Greece and Italy, but Italy's gone through a bit of a substantial shift, haven't they? Or it looks like it's going to become more of a substantial shift because there seems to be some kind of coalition government with more than a few historical connections to, the big bad Mussolini. So there is a far right element that looks like it's going to make some significant headway in leadership for Italy, and that comes less than a year after the far right party narrowly got missed out in France. So you look at France and Italy and you think, okay, well, that's just two of the member states. But then you start looking at some of the disquiet that's happening in Germany, which is, as Adam has said, is most definitely the anchor state in Europe in terms of economy and production and things like that. And you think, well, what direction is Europe going in? And how does that play out for its relationship with the UK and the UK's relationship with it?
Well, I think the thing is, there's been a bit of, you look at sterling this week, there's been some interesting things going on at the same time. We've tended, like you do when you're a nation state, to look outwards and go, oh, the pound's crashing because of this or that, yeah? But actually, the dollar index has been raging for some time.
Yeah.
The dollar index actually blew off a top on about late Wednesday, early Thursday, I think, or maybe late Thursday. And came back down a few points, which is what's put sterling back at like 111, 112, right? Because there's things going on like there always are across currencies. And that's why trading currency pairs is hard, because you can't focus on one of the two. You've got to focus on the whole lot, you know? And the euro obviously has suffered pretty much as badly as sterling has done. And I mean, I think we've spoken briefly about this before. You know, the euro doesn't pass Helen might remember who it is. There's a guy in the 1950s who came up with a pretty good framework of how currency should work. And there are three basic rules to it. And the euro doesn't really pass any of those three. So I've always been fairly bearish on the sort of long-term future of the euro. That's not to say that European countries themselves will implode. But obviously, they've been very soft on some of their GDP, debt coverage requirements, this, that, the other. And now the reality is, you know, everybody needs to borrow more in order for things to get better. And they need to inflate. They do. The reason why Kwarteng's coming from the place he's coming from is we do need growth in order to get through this. But it's how it's manifested and how you pay for it. You know, you show a business plan. If you're a private equity investor or an angel investor in very early stage companies, forget private equity. Then you look at forecasts on a piece of paper where they say, right, we've only done this in the past 6 months, but then we might do this, this, and this, and we're to the moon, as Helen's familiar with. And then you do that, you roll your eyes like Helen just did, but then you think, I'm going to take my own view on this. When could they be profitable? You know, startups, you want them to be reinvesting their money, and no one has executed that, in my opinion, as well as Amazon have done. And look how many years in a row they made a loss for, you know. So I don't understand why we don't. I hate and probably Rees-Mogg is one of the biggest sinners in this, the parallels of the UK government purse to your household finances, right? Because it's a hell of a lot easier for the UK government to borrow. But I do like the analogy of UK PLC and the government as a business, as we've spoken about before. And if there's mini startups within that bigger business that take a lot of capex up front, you know, you want to build a bowling alley or a go-kart track or a cinema or a leisure facility, you put a load of capex in, the stuff lasts for 15, 20, 25, 30 years. You sweat the money on the way out, you end up with more money than you started with. That's what's called positive net present value, right? So why are we not using, albeit maybe not as jargon-tastic as I've just said it, but that sort of language with the general public and the international markets to say, do you know what? If we put 500 billion into infrastructure, we will see a return of 60 billion a year GDP, 12% return on that employed capital. Our borrowing costs are 3 to 4. That's a spectacular return. And we will do that in a fair and meaningful way across the country in order to level up and carry on with the theory, which is a good theory, but like all theories, it needs good execution, right? Now, I don't think that language would spook the international markets, right? I think they would go, yeah, willing to back that, and then bring in the private sector from other countries, keep control, and you obviously keep, I think people get a bit over the top about when you do get, it depends what they're providing. China providing internet and 5G infrastructure. I understand the security points around that, and there's a robust debate to be had, right? But just because it's an American or a Chinese or you pick on whoever you want, probably not Russia, to be fair, but anybody else's company, you control the rule of law, for goodness sake, right? So where's the real and true threat to that? If you don't like what happens, you legislate. Then everybody says, oh, well, but you drive off future investment. But you're only going to legislate if they're bad actors. So you do want to drive away investment that's from bad actors, right? So this is why part of the Conservative Party ideology around things like academies, for example, is a good idea. But I choose my words carefully. Good idea, right? It's still about execution, and you have to have appetite. But I'm all for light touch regulation, but you need that regulation to be meaningful, right? Yeah. You don't need loads of it. You don't want bureaucracy. You absolutely don't want any of that. But you've got to have a regulator who's got teeth, rather than it being a snowplow for the old boys club or whatever. That's no bloody good. So this is it. I might consider political campaigning. Actually, I'm reasonably pleased with the last 5 minutes. That is a joke, by the way. I'm definitely not doing that. Definitely not doing that.
James has got a good comment. Read out James's comment, Piotr, about cliche bingo.
Been playing quiz bingo this morning. Adam up to about 10, but very disappointed not to hear about 6-foot guy drowning in the 5-foot river.
Yeah, give us time. Give him time, James.
House. Yeah, very good. Very good, James. I like that a lot.
Yeah, there's another one.
If you believe you can or believe you can't, you'll be right, mate, by the way, just so you know.
Yield expansion, yield contraction was mentioned. Anyone knows what yields looked like in the late 80s? Wasn't a big buy-to-let market, but must have been some lazy landlords.
20 plus gross, James, from what I know without looking. But I'm pretty sure they're 20 plus gross. But bear in mind, Housing Act 1988, buy-to-let mortgage 1989, brand new. So we've got to be a bit cautious in comparison. But going back to what I was saying about Rod's posts earlier, he's done some very good comparables regarding the magnitude of the change, or the delta, if you like, rather than just getting fixated on house property went up 413%, but inflation went up 260%. Those are not numbers that translate into today's world, because stuff breaks a lot earlier than that. But the magnitude of the difference is the important thing. But yeah, they were looking at 20 with a cost of capital of 15 plus. So, some margin, but not amazing. Not amazing. Wow. Maybe 20 to 25. So if you go back to my rent coverage comments in today's world, I put together a list of properties that I would like to take out the floating debt on, because I've still got a bit left across a mini portfolio, and shown it to a high net and pitched it to them at a premium to the bond yields at the moment, and said, look, you've got PG from me, you've got first charge, we're not gearing up to big percentages. But I, being the stupid, poor quality businessman that I am, said to him, I don't think the 125 stress test is enough. So I put these in at 150. Now, I think 150 is good and safe, but I think I've never understood why 125 is enough. And let me tell you now, it's not enough. No. It's not enough. So think of stress test percentages rather than absolute yields and rates.
Makes sense. Jay, you want to say something? I think you were on mute because of some clicking, but
yeah, no, I was about to say something, but then Adam knocked me for 6 on the last point. So. But no, what was I going to say? But I think you find that a lot of the real estate investors in the 70s and 80s, for the most part, they didn't really leverage. They didn't, because it wasn't viable to leverage. It was easier to park the cash, which it compared didn't have roughly the same kind of value, and they took the benefit of the income, and that was.
Wow.
Is he frozen in his prime? What a teaser! He's such a tease, isn't he? He's always a tease. But yeah, he raises a really good point. You know, that is absolutely valid, and it makes sense when, you know, those yields are. And then really you're comparing gross yield to inflation rather than gross yield to 90 degrees of Jay Howard. He's back. He's back. Here he is.
Yeah.
Cut off in your prime, mate. Keeping us waiting.
Maybe still, yeah.
Oh,
Okay.
right.
Oh, this is.
Yeah, it makes sense, doesn't it? And this is one of the things that I was saying today. You know, when I've shown that to a high net, I'm also saying, look, I'm not looking to rip these all up to 75%. Now, some of that is to do with the financing also being quite expensive. So you're looking at, you know, some of those properties with my 150% covenant in place. I'm thinking, right, we'll still cash flow a little bit, but the money over the next 5 years is really going to come from the asset management and the increase in those rents over the next 5 years, right? So we've got to be quite sharp on the AM front. And look, we usually are anyway, but we've got to be sharper than we've ever been before. That's what difficult times bring on, you know. So it's where your tactical focus is spent, really, if that makes sense.
Well, there's all this due to investors like you, Helen, when it's sort of like the interest rate bonds are a bit more attractive, and do you want more money, more interest on your money, more things? What do you want from your investment?
Well, it's really interesting because I know, well, there's always people looking for money, isn't there? Developers looking for money, and the usual. I don't really like connecting people because I take too much personal responsibility for other people's decisions, which is
no upside, all downside.
No, exactly. And it's not good for my quality of sleep. But where I have known kind of personal friends and I have worked with developers before, and I'm like, actually, they could have a good working relationship and that could be a good match. I've done that before. But I was speaking to one of those friends this week, and she's like, oh, well, we did this deal with so-and-so at this rate. And she said, but, you know, like, but now with the base rates going up, you know, can I get this such and such? I'm like, you can try, but let me tell you, the developers haven't. It's like landowners, isn't it? Like the change in there, getting them to change and bring the realism in of actually what's happening takes quite a long time. I'm like, you know, ask by all means, but I'm not fighting your corner for you, even though I agree with you.
Well,
but definitely looking for more. Yeah, definitely looking for higher. But the thing with that is, again, it's kind of been the theme of today, hasn't it? We can't look at these things in isolation. I'm like, if you're now looking and you want higher rates, and also a bit because of the similar to my journey, like you start off at, you know, a reasonable rate and you've got a first charge. Now they're comfortable with the person. They're like, actually, I want a higher rate, and they'd be happy, more or less happy with a second charge. I'm like, well, that's how you bring in and go for that conversation. If you just go, oh, well, you were paying me 10%, but now I want 16. I'm like, good luck with that negotiation.
I think this is really very interesting because we spent the better part of this call talking about how investors should really start buckling under, trying to, work their assets, stretch it, make sure that they can get the right kind of income to service the debt and do all these different kind of things. But then especially for private or angel style investors like yourself, Helen, there's if you've got capital just sitting there, capital is being eroded by inflation. So there is an argument to say, if I put my capital out at 8% and inflation's at 10%, I'm still retaining a lot of my capital because I'm reducing the erosive aspect of inflation. So sometimes it's a case of, I could double it and I could be protected, but actually the chance of me getting my money out there at 16% is and you could probably even start beating banks on how you're leveraging out, because for you as an investor, you are mitigating your risk of inflation against your capital. You're still getting things at work. You're still delivering capital at a value that enables someone to complete a project rather than you having to think, right, they're going to default. I'm going to have to go through this, then this, then this. And there's a counterproductiveness to that, a lot of that. So that's my gut feel, but I'm not an angel investor or a developer, so I kind of come at it from a typical point of view.
I think that's really good though, and I think you've seen what happens this year when people start saying inflation's running away. 13, 14, there were forecasts at 18, 22. As soon as you start seeing things like that, there's intervention. Right now, there was a very clear cause in that for the UK. Our energy security is an issue. And so, that's formed a big part of what's happened. However, inflation, as it does, starts a cyclone upwards. And so that's why core inflation has taken off. And this has been a big part of my argument over the last 20 months. Core will take off. And that gives you a different problem. So someone the other day said, well, this is a supply side issue, not a demand side issue. I was like, sorry, you need to change your narrative. That was right 9 months ago, but it's wrong now. You're not with the program. Look at core. We've overtaken the US's core inflation, which has got a stronger underlying economy, right? That's what needs snapping off. And you don't need to make decisions based. Yeah, inflation's 10 today, right? Helen, anybody doesn't need to make the decision. I don't make my decisions based on 10% inflation. I know the central bank has a mandate and they're going to try and get it back down to 2. And the means by which they do that when it's 10 are ugly, right? Because it hurts people. But I don't worry about, I'm not looking at a 10-year bond or a 50-year bond thing. I mean, those 50-year bonds this week that were 4.75, what a play. If you're a pension fund, if I was Warren Buffett sitting on $130 billion of cash, I would have got heavily involved in it because it gives you so much protection. Where's the effort? It's nowhere. Now, you could go back to my conversation and say, I'm unrealistic about the creditworthiness of the UK, but I just think you're being emotional. You're looking at this week and, a couple of dickheads in charge. You're not making a sensible decision on the next 50 years of the United Kingdom. I made a big point today around the rule of law, around the quality of the universities, specifically Oxford, but an honourable mention to Warwick. The other bits of the other universities are available. And these are all important points around. It doesn't change overnight, and it's a classic emotional reaction. Whereas if you are the cold-blooded trader, you can just go, or even if you were on a pension fund committee, I mean, if you weren't one of the ones scrambling around going, we've got a margin call, you'd have been absolutely ploughing into those bond yields because it's more than enough to cover your requirements for the next 50 years. Spectacular. And if you'd done that, by now, you could sell them at a 20% profit today anyway. Not quite 20% on that duration, but still, you probably made 9 or 10% this week if you'd done that, and that's pretty good. Pretty good.
Great. Well, I think there's lots to take in and lots to kind of.
Any more from the floor, Piotr? Any more from the floor?
From the floor of auctions and
questions. No questions.
Oh, sorry. No, nothing on the floor. Sorry, it's.
Everybody got their head under the quilt. You can't do that, guys. You've got to come out and play.
Yeah, it's just been a few comments. How interesting the conversation was. Interesting. And we'll call the property pros. Thank you, Matt. No other questions so far. If anyone's got some.
What are you guys up to in the next week or so? Attending any events or got anything on? What's going on?
Oh, we do have to give a mention to the HMO Awards, I think.
I think we should.
And actually, we had a really good discussion, didn't we, with somebody that's big in the HMO space, been around a long time. And you were so that I was chatting, we got on about risk, and actually he's said he's been slowing down and deleveraging, reducing his risk over the past year. And I just loved this. Actually, if Will's listening, I think Will's actually on a Bradford call, but I want to set that person up with Will for a podcast, because definitely. I think you need people with that experience. talking about what they're doing, and rather than going up and leveraging and build and let's go for ego driven stuff, actually doing like you do, looking at what they've currently got and assessing the risks. Where are the vulnerabilities? And like I say, he's just been deleveraging, looking to reduce that LTV and taking things slower to position himself more solidly going forward. And I just loved, we had an amazing conversation, didn't we, Adam?
We did. I mean, it'll surprise everyone, Helen, I'm sure, listening to this, that you and I were at a party with a bar and we were still having an in-depth conversation about risk. But it was a very rich conversation. It did. And I totally agree. Definitely needs to do the podcast because it'll be great. Yeah. And it was spot on because like a lot of our discussions this year, he had seen some of this coming or trouble in the pipeline, and he'd taken the steps in order to protect himself. And one of the big points I made today was, even if you haven't taken action yet, it's not too late. Don't have buyer's remorse and go, oh, I should have had that 2.85%. Doesn't matter. I haven't hit every rate that I would or should or could have hit this year, right? Nobody with a portfolio will have done, right? But there's still time to take action. Fix at 6 if that's what you need to do, or work out on your asset management strategies what you're going to do. But doing nothing / head in sand is always the worst thing to do. And that's kind of what Jay was just saying about the capital side of it, Helen, wasn't it? You know, we don't need to worry that over the next 2 years, is inflation going to average 8? I don't think it is. You know, I think it's going to average 5 to 6 over the next 2 years. So if you're getting 8, even though today 10 might feel a bit into over the 2 years, which might well be the duration of the sort of things you're investing in, you've still got real returns. And if you've got real returns, you know, happy days. Happy. There haven't been real returns for a long time for a lot of places. So, you know.
Yeah. And as you always say, and just for James's cliche bingo, it's return of capital rather than return return on capital. Oh.
James on the comments. Great job, by the way, Helen. I was smashing through. Tomorrow was just under 30 minutes on Friday night.
It was about an hour, but still, I had to do 80. Van said to me, Van Bogstad, that was the organizer, he's like literally just before we started, he's like, so we'll get this wrapped up in an hour and a half, right? And I'm like, I'll try my bloody best, but I can't guarantee that. 18 awards to get the judges up, the winner up, present it. I'm thinking, oh my God. And actually, I did it in an hour. Yes. And I think I made myself really popular with the audience because I'm like, right, we can all go and get a drink. Probably a little bit too efficient, but
I think it was bang on. And you even timed it so the rain stopped so we could get back over to the main place. And then it started raining again. It was an absolute dream, really, to be honest. So, yeah, it was an amazing venue. A really well-run event, really well-marshaled. Helen was absolutely spectacular. I'm not just saying that because she's a really, really professional. And some really, really worthy winners and some great stories. And as there always is at those sorts of things, just fabulous networking. You know, some few big guns of property in a room, few sharks and pretenders like usual, few egos. You know, obviously not me because I'm extremely humble at all these sorts of things. But yeah, it was, in seriousness, it was really good. And I very much hope, and I think they'll be doing something next year. And I'm sure, knowing the way they think, it'll also be bigger and better, although that will be difficult to top.
Yeah.
But always some hidden gems, people you've never met before, people you've not heard of, you know, who then you're really pleased that you have heard of. So I really made the most of it, really enjoyed it. My favourite bit was pretending to be Rod, of course, but, you know, there was always worth a bit of banter.
That was good. That was great.
Amazing. Well,
but it was a lovely atmosphere. It was very, you know, it wasn't kind of a typical kind of award ceremony, black tie, all sat around a table. It was, they had these TED style talks in the day, 2 rooms going on at the same time, just short kind of 15-20 minute talks, which I think worked really well because I don't know about you, but my concentration span, certainly over lockdown, has gone a lot littler. So that was really good. And it was just casual, you know, it was just very relaxed. And yeah, Helen, Turner and Van just set the tone of the day, was really good. And then, I did my Miss Efficiency. Yes. to get to the bar.
Amazing. Well, if we ever go
And
into
talk about
lockdown,
risk.
I would talk about what we did. We just talked about risk. Oh, dear.
oh, amazing, great stuff. Well, maybe at one point we can do awards on our Sunday specials. Because if you can turn it around in 1 hour, Helen.
Alternative awards, that would be good. Shark awards.
Biggest shark in property, maybe.
There'll be a lot of splitting hairs on that one, Adam.
There'll be a couple of nominations, Jay. I'd imagine. Yeah, a couple of nominations. Yeah.
Imagine the ego of some of them that actually apply for it for themselves.
Yeah. Some of the more litigious ones, we may have to do that as a private session rather than a live broadcast.
Oh, amazing. Good stuff. All right. Well, thanks everyone for contributions. Yeah, we'll be back next week with more updates on what happened in auctions, what happened in the markets, and what happened with mortgages, and where the market is heading. Who knows what else we're going to cover next week.
Have a good week, everyone.
Yeah,
have a great week.
Bye, everyone.